I have a riddle for you today.
Okay, let's hear it.
And honestly, it's a puzzle that pretty much every investor or, tech executive or really anyone with a retirement account needs to solve right now.
Sounds serious.
It is. Imagine an industry-leading tech titan. They put out their quarterly earnings, right? And they report record-breaking revenue.
Good so far.
Right. And they absolutely crush their artificial intelligence growth targets. I mean, up by over 200% year over year.
Wow.
Yeah. So by all traditional metrics, they just knocked the cover off the ball, and yet their stock plummets 32% this year.
In a year where the broader market is just soaring.
Exactly. The NASDAQ is up, what, 19%? So how is that outcome even mathematically possible?
Well, it sounds completely irrational on paper, I'll give you that.
Right.
But when you actually look under the hood at the underlying unit economics, it makes perfect, ruthless sense. Because we are witnessing basically a historically unprecedented collision right now. On one side, you have the old legacy pricing models that built these massive software empires over the last 20 years.
And on the other side?
The new reality of agentic AI is just hyper-efficient. And those two paradigms are crashing into each other. And it's basically shattering the foundation of enterprise value.
Well, welcome to the Deep Dive. Today, we are unpacking the May 27, 2026 edition of Aaron Rose's Tech Reader AI Digest.
It's a massive issue this week.
It really is. Our mission today is to cut through all the relentless tech hype, and really examine three monumental financial stories from this digest.
Yeah, because we need to look at how this AI transition is fundamentally rewriting the rules of business models.
Exactly. Enterprise software infrastructure, and ultimately how you invest your own money. So let's unpack that opening riddle, because it is the story of Salesforce right now.
Yeah, Salesforce provides probably the clearest case study available for the central tension in enterprise AI.
Let's lay out the facts from the digest. So Salesforce reported their Q1 FY 2027 results. Revenue is at $11.1 billion.
Which is up 13%.
Right. And their non-GAAP earnings per share hit $3.88. But the defining numbers are really the AI metrics here.
The Agentforce numbers.
Yes. Their Agentforce and Data 360 combined annual recurring revenue.
AUR.
Right. Their ARR hit nearly $3.4 billion. Agentforce alone reached $1.2 billion, growing 205% year over year.
Which is staggering.
And the wildest statistic, at least to me, is that the platform processed 3.8 billion agentic work units in a single quarter.
Okay, wait, let's pause on that phrase, agentic work units, because
Sounds like corporate jargon.
it totally sounds like jargon. But it is actually the key to this entire puzzle. To understand the shift, you have to understand what one of those units actually is.
Right.
Because, 2 years ago, interacting with AI just meant querying a chatbot.
You ask a question, it gives an answer.
Exactly.
Yeah.
But an agentic work unit is entirely different. It's an end-to-end automated task.
So, what? Give me a real-world example.
Well, it means the AI receives a customer complaint, right? Then it cross-references the customer's purchase history in the database.
Okay.
It determines if they're eligible for a refund, issues the credit through the payment gateway, and then drafts a personalized apology email.
Wow. All without a human doing anything.
All without a human ever clicking a mouse. And Salesforce executed 3.8 billion of those complex workflows in 3 months.
Which prompted Mark Benioff to declare agentic AI the biggest growth opportunity for their customers and for Salesforce.
All right.
Yet the stock is down 32%. Like we said, the NASDAQ is up 19%. Wall Street's consensus target is $274, but Bank of America just handed them an underperform rating.
With a price target of, what, $160?
Exactly. Citing, quote, structural growth risk.
Yeah. And see, the market is pricing in the disruption of the very business model that produced these record numbers in the first place.
The seat-based model.
Yes. For decades, companies like Salesforce built their empires on a seat-based licensing model. A company pays a monthly subscription fee per human employee.
Per seat.
Right. So if a corporation employs 10,000 sales reps, Salesforce sells them 10,000 software licenses.
Okay, let's unpack this. I kind of think about it like a highly profitable taxi company.
Okay, I like where this is going.
Right. So you make all your revenue by charging human drivers a daily fee to lease your cabs.
Sure.
Then your engineering team successfully builds the world's best self-driving cars.
The agentic AI.
Exactly. And the vehicles are incredibly efficient. The passengers adore them. But you suddenly realize your entire $30 billion corporate structure relies on charging by the human driver.
Not the mile-driven.
Right. And your brilliant new invention just eliminated the human driver.
That is exactly it. The transition from seat-based pricing to consumption-based AI pricing is the software industry's self-driving car moment.
It's just wild to think about.
It is. Because Bank of America is looking at those 3.8 billion agentic work units, and they are basically doing the math on human displacement.
Right.
If a client realizes they only need 5,000 human sales reps instead of 10,000.
Because the AI is handling the heavy lifting.
Exactly. Then Salesforce instantly loses 5,000 monthly subscription seats.
But, I mean, I have to push back on the pessimism there just a little bit.
Go ahead.
If the AI is making those clients exponentially more efficient, shouldn't Salesforce simply charge a massive premium for the AI itself to make up the difference?
That's a logical argument, yeah.
Right. If the automated work is generating value, the revenue should follow the value creation.
Well, what's fascinating here is that the technological transition is clearly working. I mean, you don't hit 200% growth if the product is a gimmick.
Right. The AI actually works.
It does exactly what it promises. But the anxiety on Wall Street is strictly about the timeline and the revenue baseline.
What do you mean by baseline?
Well, can Salesforce scale the pricing of these agentic work units fast enough to plug the hole left by a collapsing $30 billion legacy business? If an AI agent does the work of 5 humans, but Salesforce can only charge the equivalent of 2 human licenses for that compute power,
then their total revenue shrinks.
exactly, even as their product gets vastly superior.
Right.
The bear case basically argues that AI is inherently deflationary for enterprise software.
Wow. So if you are a mid-level manager listening to this right now, the implications are immediate. You are no longer just managing a team of human employees using software.
You're managing agents.
You are actively managing a portfolio of software agents. And Salesforce is aggressively leaning into this reality. Cannibalization risks be damned.
They don't have a choice.
Right. And there is a specific line item in this earnings report that proves they are abandoning the old model entirely.
The Anthropic deal.
Yes, which connects us directly to the infrastructure powering this whole shift. Salesforce confirmed a committed spend of $300 million just in 2026, purely for Anthropic token usage to run this agent architecture.
That is a $300 million lifeline to the company actually providing the cognitive engine.
Right, and I want to break down that phrase token usage for the listener, because $300 million sounds like they're buying a physical asset, but tokens are essentially the microscopic currency of AI compute, right?
Yeah, think of a token as a fragment of a word or, a tiny unit of computational thought.
Okay.
Every time one of those Salesforce agents reads an email, analyzes a database, or generates a response, it consumes thousands of tokens.
So they are paying for the brain power.
Exactly. Salesforce is paying Anthropic for the raw cognitive processing power required to execute those 3.8 billion work units.
Which brings us to the staggering numbers surrounding Anthropic itself. Because according to the Digest, Anthropic just closed its final private funding round at a pre-money valuation of over $900 billion.
It's just a massive number.
It is. They have officially surpassed OpenAI's $852 billion valuation from March. They are now the world's most valuable private AI startup.
And they are targeting an October 2026 IPO.
Which could be the largest in tech history.
Yeah, and look, valuations of that magnitude demand flawless execution, but the underlying revenue ramp actually justifies the frenzy here.
Let's hear the numbers.
Okay, in January of 2024, Anthropic had an annualized run rate of $87 million.
Okay, $87 million.
By April 2026, that figure exploded to $30 billion.
That is insane.
And they're currently projecting $50 billion in ARR by the end of June 2026.
Wait, going from under $100 million to $50 billion in roughly 2.5 years? That defies the laws of traditional software growth.
Completely.
How is that physically possible? You can't hire enough salespeople to close $50 billion in enterprise contracts that quickly.
Well, you don't need a traditional sales force when you are selling the foundational infrastructure of the new economy. Right? Anthropic is no longer selling a packaged application or a clever chatbot. They operate much more like Amazon Web Services did in the early 2010s.
Like a utility.
Exactly. They provide an API, basically a plug-in point, for enterprise compute. So when a corporation wants to automate They don't build their own AI from scratch.
They just plug into Anthropic.
They just route their systems through Anthropic's models.
And the digest highlights exactly how deeply this infrastructure is embedding itself. I mean, PwC deployed Anthropic to 364,000 professionals.
Yep.
And Uber just disclosed that 70% of their committed code now comes from AI tools led by Claude Code.
70%.
I really need to understand the mechanics of that. Does that mean human programmers at Uber are just, like, copying and pasting from a prompt window?
No, the integration is much deeper than a human acting as a middleman.
Okay.
Claude Code is baked directly into Uber's CI/CD pipelines.
The continuous integration stuff.
Exactly. So when a human engineer outlines a new feature, the AI drafts the architecture, writes the actual code base, runs the preliminary security tests,
Wow.
and even flags potential bugs.
So the human engineer has transitioned from a bricklayer to an architect.
That's a great way to put it. The AI is laying the bricks, which is why 70% of the final committed code originates from the machine.
Okay, here is where it gets really interesting, especially the financial subtext. Let's look at the investors who just handed Anthropic this $900 billion valuation.
The big players.
Right. The round's co-leads include Sequoia Capital, Dragoneer Investment Group, and Altimeter Capital. These are the exact same heavyweights who previously bankrolled OpenAI. So my question is, are these venture capital firms just playing standard Silicon Valley risk diversification, like placing chips on all the roulette numbers? Or are the very people who built OpenAI now making a definitive verdict that Anthropic has won the enterprise AI war?
If we connect this to the bigger picture, it's pretty clear. I mean, while venture funds always hedge their bets to some degree, leading around at a near trillion-dollar valuation is not a casual hedge.
No, definitely not.
Firms like Sequoia, they possess granular visibility into the unit economics, the enterprise churn rates, and the raw compute efficiency of both companies.
They see the real numbers.
They see everything. So by funneling this level of capital into Anthropic's final private round, they're basically acknowledging a shift in dominance regarding enterprise architecture.
That makes sense.
Anthropic has proven it can handle the security, the compliance, and just the sheer volume required by companies like Uber and Salesforce better than the competition.
Which brings us to the physical limits of this. The only thing that could realistically bottleneck Anthropic's path to $50 billion in revenue is physical compute power.
Right. The servers.
They need an astronomical number of servers to process all these tokens. And the closing documents for this funding round accidentally revealed who is consuming the most of that raw compute.
And it isn't Salesforce.
No. It's a contract for the SpaceX Colossus 1, priced at $1.25 billion per month.
Which is $15 billion a year in compute expenses from a single client.
It's just staggering.
That figure illustrates the sheer scale of SpaceX's current orbital and logistical modeling. And honestly, it provides a seamless pivot to the third tectonic shift happening in the markets this week.
You're talking about the SpaceX IPO.
Yes.
Ticker symbol SPCX. Trading opens on the NASDAQ on June 12, pricing the night before.
Right.
They are targeting a $1.75 trillion valuation, seeking to raise up to $75 billion.
Which will obliterate the record for the largest IPO in capital markets history.
Yeah, it doubles Saudi Aramco's $35.4 billion raise.
The market cap alone makes it a generational event. However, the true disruption lies in the S-1 filing.
The structural mechanics.
Exactly. Specifically in how these shares are being distributed to the public.
Right. 30% of the float is being routed directly to retail investors at the IPO price. And this is happening through consumer brokerages like Robinhood, Fidelity, Charles Schwab, SoFi, and E-Trade.
And for the listener, just to clarify, the float simply means the total number of shares that are actually available for the public to buy and sell.
Thanks for clarifying that. But 30%, that's a radical anomaly, isn't it?
It really is. To grasp why that's so massive, we have to look at the traditional IPO playbook.
Right.
Historically, the investment banks managing an IPO allocate 10% or less of the float to retail investors.
Sometimes even zero.
Exactly. The vast majority of the shares at the ground floor IPO price are locked up by institutional buyers. Hedge funds, sovereign wealth funds, massive pension portfolios.
They get the preferential pricing.
Always. And every day, retail investors are forced to wait until the stock officially opens on the secondary market.
Which is usually after the price has already popped 30 or 40%.
Right. Wall Street fiercely gatekeeps the initial pricing event.
So what does this all mean for you? If you are listening to this and you have a basic Robinhood app on your phone, You theoretically have direct access to a trillion-dollar IPO at the exact same price as a Manhattan hedge fund.
Yep.
But let's apply some critical skepticism here, because Wall Street didn't suddenly wake up and decide to share the wealth out of the goodness of their hearts.
Definitely not.
Right. Are we supposed to believe that? Or is routing 3 times the normal float through consumer brokerages just a strategic ploy to manufacture blind retail hype?
That raises an important question.
By spreading the shares across millions of small accounts, do they dilute the voting power and avoid being beholden to a handful of massive institutional whales?
Well, the S-1 filing suggests it's a brilliant piece of financial engineering that basically accomplishes both.
Really?
Yeah, Aaron Rose points out in the digest that broadening the shareholder base stabilizes the stock against aggressive institutional short selling.
Ah, okay.
But we also need to examine the practical reality of this allocation mechanism. The demand for these shares at the IPO price will overwhelmingly exceed the supply.
Obviously. If 30% of a $75 billion raise is available, every retail investor on Earth is going to submit a buy order.
Right, so the brokerages are implementing different filtering mechanisms to handle the tidal wave of demand.
Like what?
Well, Fidelity, for example, is requiring a minimum of $500,000 in household assets just to be eligible to request shares.
Okay, so they are prioritizing their high net worth clients.
Exactly. But Robinhood, true to its brand, has no minimum balance requirement.
So anyone can get in.
Well, their allocations will be distributed through a randomized algorithm. It's effectively a lottery system.
Oh, wow.
Yeah, millions of users will request shares, and many will receive partial allocations or, absolutely nothing at all.
So the democratization has terms and conditions. It is not a guaranteed golden ticket just because you downloaded the app.
The friction in the allocation process is very real.
Yeah.
But it shouldn't distract from the structural precedent being set here.
You think it's that significant?
Oh, absolutely. Forcing open the doors to a 30% retail float fundamentally alters the power dynamic of capital formation.
Right.
A company valued at $1.75 trillion is bypassing the traditional institutional book-building process to crowdsource a massive chunk of its public debut.
That's true.
It signals that modern mega-cap companies just no longer need to rely exclusively on legacy investment banks to generate liquidity.
So looking at the 3 stories we have unpacked today, a very clear narrative emerges about the destruction of legacy systems.
Everything is changing.
It is. We started with Salesforce, watching the old seat-based software pricing model collapse as agentic AI physically replaces the human workers that those licenses were tied to.
Right, and then we examined Anthropic, witnessing the hypergrowth ascent of a completely new infrastructure.
Going from 87 million to 50 billion in revenue.
Just by providing the raw cognitive compute that allows companies like Uber to automate 70% of their software engineering.
And finally, we see SpaceX rewriting the mechanics of the capital markets. They are bypassing institutional gatekeepers to grant everyday retail investors unprecedented access to the largest IPO in human history.
Yet the velocity of these structural shifts is just breathtaking. The rules of business are being rewritten in months, not decades.
Exactly.
And, the convergence of these trends leads to a really fascinating and honestly slightly unsettling future scenario.
Oh, what's that?
Well, consider the through line we just discussed. Uber's using AI to write code.
Right.
Salesforce is deploying billions of autonomous AI agents to handle enterprise tasks.
Okay.
And retail brokerages like Robinhood are gaining direct access to institutional-grade IPOs.
I see where you're going with this.
Right. As these agentic AI models become deeply integrated into consumer personal finance applications, how long until it's not actually you scrambling to buy SpaceX stock on Robinhood?
Oh.
How long until it is your personal AI agent analyzing the S-1 filing, calculating the exact probability of an allocation on Robinhood, and executing the trade for you milliseconds faster than a human finger could ever tap a screen?
That is wild. What happens to the entire concept of a stock market or even a retail float when the participants are no longer human beings reacting to news, but millions of autonomous algorithms just trading against each other at the speed of light?
We might soon find out that the ultimate disruption of AI isn't just how companies build products, but how the ownership of those companies is traded.
That brings us full circle, right back to our opening riddle.
It really does.
Perhaps the most difficult puzzle isn't how a company's stock drops despite record earnings. The real riddle is figuring out how the global economy functions when the entities doing the working, the coding, and the investing are entirely synthetic.
It's a lot to think about.
It really is. Thank you for joining us on this deep dive. Keep questioning the mechanics behind the headlines, look for the structural shifts hidden in the data, and we will see you next time.